All right, folks, welcome back. This is episode 33, I think, of the ICT Mastery Mentorship. It's been at least 2 days since I recorded anything. So let's get started, I guess. We're going over Silver Bullet this episode. We're not going to make this introduction professional or good sounding. We're just going to dive straight into it. Silver Bullet, okay, it's basically like a quick little setup that you can take in the morning, okay? There's multiple different Silver Bullets, though, okay? You have a New York one. There's really two New York ones and one London one, okay? In which they're time-based. It's a time-based setup that in which the frame for you to take the setup is an hour, but you can hold the trade outside of that time. So there's three Silver Bullets, okay? For New York AM or New York morning, it's from 10 to 11. From the New York PM or New York afternoon, it's 2 to 3 p.m. Okay. And then for London, I think it's 3 to 4. I think it's 3 to 4 a.m. Let me just go to my definition and make sure. Hold on. Hold on just a second. I'm glad I made this thing so I can just, refer back to it if I ever need to. Yep, 3 to 4. London Silver Bullet is 3 to 4 a.m. Remember, it's always New York time. Remember that. Always New York time. And just a little reminder before we start, please use this compendium. I didn't write all this for no reason. This is for you to use. It's a lot of definitions that's here. Okay, so if you need to use it or refer to a certain definition or concept, everything is here in the hyperlink, all of it. Okay, so just know that. Anyway, let's go to the morning silver bullet or New York morning silver bullet, which starts at 10. When it comes to the silver bullet, you don't need a lot. That's why I called it like a real simple setup timing. You probably only need liquidity, fair value gaps, and maybe an order block. Okay, it's a very simple interval in price. You don't have to do a lot. So let's drop down to the 1 minute here. And when you're looking for your entries, confluences, and reference points, you mainly want to stay on the 15-minute and lower. I mean, not 15-minute, but 5 minute and lower because you're in a 1 hour interval. Okay, from 10 to 11, that's 1 hour. So if you go to the 15 minute, you're only going to be seeing what, four candles worth of data. It's not enough. So 5 minute and below is where you should be looking for, your reference points, your entries, and stuff like that. Okay. So let's put a little marker here, marking 11 o'clock. Here we go. So here's the silver bullet starting at 10 o'clock. This is New York AM, New York morning. Ready? Right off the bat, you can take your trade within this. Not saying you have to get in your trade within this and get out by 11 o'clock. Not true. You can take your trade within 10 to 11. Okay. And if you have to wait all the way till 10:56 for your setup, you can do that, but it just has to be placed within this interval here to get that high probability, simple silver bullet setup in which you can hold it throughout the day or hold it to your target, whatever you got to do. Now, just paying attention to the price action here, now that's one thing I did not mention also. You don't have to pay attention to just the price action that's going on within this interval here because you're like, oh, well, we're just looking at this 1 hour of price. No. You can refer back. You can refer back and see if it's touched the fair value gap, touched the order block, touched a different type of block. Like what blocks have I taught so far? I don't think I've taught all the blocks yet, but you can refer to other reference points and other liquidity levels behind or to the left side of price. Okay, outside of this interval, you don't just have to focus on all the price action that's within 10 to 11 o'clock. Anyway, enough details. Let's get into it. So right off the bat, 10 o'clock opens up, it drops, hits a fair value gap right here. See that? Hits that fair value gap just barely. Does it even touch it? Yeah, it does by a tick. That's crazy. Yeah, it hits it by a tick, and then it proceeds to jump higher, taking out buy side, fails to go above buy side. So you're like, okay, fails to go above buy side liquidity here. So this is a liquidity purge. There you go. Rally down into the fair value gap. Forgot to make this a fair value gap also. Rally down, bounce, up into liquidity, fails to hit it. We come back down, we take out all these short-term lows, purge, purge, purge. Let me put on thing. Purge, 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 purge. Everything is just getting ran. Okay. So when you see something like this, you might be like, okay, price is running both sides of liquidity, but we have to identify which side it really wants to run in. So let's pay attention to what side is being respected and I guess you can say, what's the word? Acknowledged the most. Which side of the market is being acknowledged the most? Well, if we can see, from what we can see, this fair value gap, this original fair value gap that we first marked, got tapped again. Wow, yeah, pretty amazing, isn't it? Yeah, I know. We touched that fair value gap again, doing what also? Taking out this level of liquidity. in which we fail to go past this one because what? The fair value gap is not necessarily in the way, but it's using that fair value gap to reprice lower to take out the liquidity in order to reprice higher. Now pay attention to this. Price moves away. Listen here. Listen, just listen. We have time distortion before this drop lower, in which right after this drop lower comes what? A macro, which is what? 1050 to what? 1110. We've already done what? We've already sought an imbalance and we've already sought liquidity. So the only thing that the macro has to do is seek more liquidity. But by going where, JJ? Well, where? Well, it can be this high here. Or reminder, you can go back in time. You can go back. So you can jump up to that 5 minute. You can jump up to that 15 minute. That's one thing I forgot to mention also. If you're going outside of that interval's price action, you can use anything other than the 5 minute. Okay. But if you're looking at reference points and signatures and basically stuff that happens within 10 to 11 o'clock, you would want to be on the 5 minute and below. But if you're going outside of it, anything outside of this radius over here or even over here, you can use anything that's above the 5 minute. Okay. Any time frame. But like I said, one more time, if you're looking at price action within 10 to 11 o'clock or just within the silver bullet interval, you need to stay on the 5 minute and below to get accurate, reference points and stuff so you can actually get that profitable, easy trade. Now, I did say that macro should begin the seeking of liquidity. It should begin, price wanting to seek liquidity. What liquidity are we looking for? Well, let's really look around here. Every single gap on the hour back over here has been filled at that point, except for that one there. But but there is an order block here. There's an order block. So since we have this order block encapsulating, is that how you say it? Encapsulating, something like that. Encapsulating. It's encapsulating this fair value gap within it. So this fair value gap is missing what side of delivery? We've delivered lower, but what side is it missing? Buy side. You might be like, oh yeah, it's missing buy side, right? No, it's not, because this order block was the last candle that had buy side before we started delivering sell side, in which that fair value gap is where? It's within that order block. Want to see? That fair value gap is within the order block. So buy side and sell side has been delivered here. So this is not a fair value gap, in which that fair value gap has not theoretically, but I guess you can say not even technically, but it's literally been filled. It's not telling you directly, but I guess you can say it's indirectly been filled, basically. But that fair value gap is not a fair value gap no more. So there's no imbalances that needs to fill. And the only next point of liquidity that we have is what? It's this short term high here, or the Sunday's opening. See that right there. 6 o'clock, Sunday's opening for a new week. So that's another point of buy side liquidity too. In which just after that, okay, mind you, we have another high in which that fair value gap was already filled. So past that high is just what? This right here. And then we have these two up close candles, which is an order block, which has already been exhausted. Okay, we came back up into the order block and said, oh, okay, this order block is done. Look how much we displaced after we touched that order block. You really think price is going to come back up there one more time and respect it? No, it's not going to happen. So this order block is not on our way too. It's not. Price is going to ignore that. So we have now two areas of buy side liquidity that we can refer to. Let's drag this all the way over so we can really see it. And this one. Then we're going to drop back down to that 1 minute here. Here we go. Now, where could you have taken your entry? During the macro, the 1050 to 1110 macro, or right before it? Well, let's see here. After the touch of the fair value gap, seeing it respected, you have, let's see, what can we use for the break and market structure? We'll use this high right here, that high there, because that was the high or the most recent high before price started delivering lower to take out that level of liquidity right there. Oh, wow. Learned something new, didn't you? So we're going to be using that high there. That would be our break and market structure, in which did price ever hit that fair value gap? I don't think it did, no. But if you want to confirm with that break and market structure, you can. Price comes all the way up, hits the break and market structure. This order block is exhausted here. Tap, tap, tap. We just keep tapping it multiple times. Then we jump higher, in which we take out this high here. We do have, let's see if this is an imbalance right here. Is this an imbalance? Yep, it is an imbalance because we have buy side delivery here, and then we have, you know, this delivering lower. So this fair value gap is balanced. So what could you use for your entry? There's really a lot of things you can use for your entry, honestly. But there is some concepts I do not want to leak yet. I really don't want to leak any concepts yet. But if we're just anticipating the respect of this to work, then we can use this order block here. That right there. See that? Price taps it 1, 2, 3, 4, 5 times. Was it? Yeah, 1, 2, 3, 4, 5. It's a pretty good amount of times of respect and never even digging into it. So if you see that, I would consider that a valid point of entry. If I saw this in in real live markets, I would take that. Just me personally. That's me personally. I'm trying to teach you what I do. I would take that. But if you want to just confirm it even more, hey, wait for the break in market structure. You can do that. You totally can. Now I'm trying to see where could you have entered after the break in market structure. Let me see. So we're just going up, 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 up. Yeah, there's really nowhere else, honestly, unless you want like the 15-second or something. But on the 15-second, this price action here would probably look real janky, very consolidation-ish, or whatever you want to call it. It's very choppy. So I think this is the only high probability entry that you could get for this silver bullet, honestly. But that's just one example, which is going to be three because we're going to have one example for each silver bullet. So let's go ahead and remove all our drawings. Now, the next silver bullet, which is, let's see, what did I say? 2 to 3? Yeah, 2 to 3. Here's 2 p.m., 2 p.m. to 3 p.m. There you go. All right. Now, reminder again, you do not, when I say you do not have to take your trade within the silver bullet and exit it at the end of the silver bullet. You don't have to do that. Okay. But if you want to take your high probability silver bullet easy trade, then you must place it within here. Okay. And you can hold it outside of the silver bullet as long as you want. But if your target gets hit early and it gets hit at, for example, 245, then hey, you're good. You're really chilling. So let's just see what type of liquidity we can, get for a target. Well, first of all, we have all these relative equal highs, which would we consider them equal highs? I would. Yeah, I would consider them equal highs. So we have buy sell liquidity there, and then right above that high, just about, what is that, 2 points away, we have that high right there. Okay, so we got buy sell liquidity mainly resting above here. Previously, at the start of the opening here, we had a good amount of time distortion, just back and forth, back and forth, back and forth movement. 2 o'clock comes in, drops lower, in which we have accumulation, manipulation. Hear me out. Listen to me here. We have accumulation right here, back and forth, back and forth. Then we have manipulation. 2 o'clock kicks in, drops a little bit lower. What does it go to? Huh? What is it going to? Let's see. Let's look over here. It's definitely going to something. I don't know what, but it's definitely going to something. Um, yeah, it's referring back to this order block. I know I wasn't tripping. Yep. Look at that right there. Referring right back to it. And no, it's not exhausted. It's not, because look how it delivered away from it. Price can still come back to that. That's still a valid order block. We dig into it multiple times, 1, 2, 3, 4, and then sometimes we just stay in it like within an entire candle. We move away from it, come back in, we move away from it, but we don't really displace away from it. So this order block is still valid. We can still use this. So price refers down to that order block, respects it pretty well. Look at how the bodies. Want to see something? If I can get it, Jesus Christ. Uh-oh, I just leaked something, guys. Uh-oh. Look at the bodies now. Look at that. You see that? Wow. Amazing, isn't it? Respects the equilibrium perfectly. When you see that, that's a pretty good confluence that price is going to reverse. And does it reverse? Yeah, reverses with a good amount of volume, consolidates here and there, but it still reverses decently well. In which, let's get rid of that order block. We have another order block digging into that order block. This is a different block, but for right now, I'm going to consider this an order block because you do not know what this PD rate is yet unless I teach it. So here is another order block that you can take, in which we do have a break in market structure up here. That right there be the break in market structure because it is the most recent swing before price starts delivering lower to seek some sort of reference point and or liquidity, okay, in which we took out liquidity multiple times. Here, here, and here. And I think here, I think it was real close. Yeah, it went literally one tick under that. So, yeah, that we purged 3 levels of liquidity. Pretty good, right? I would say so. But the accumulation, manipulation, and distribution mindset is still in play. Because reminder, accumulation, manipulation, yeah, you can finish it. We refer to the order block one time, but I me personally, us being this deep down here, it doesn't really show a lot. And then just that little tap, and look at how we react off of it. Just in hindsight, we activate the order block by coming above it. We tap it, but look at the reaction afterwards. I wouldn't take that. So just don't even worry about that. We start displacing afterwards. You're probably like, oh, it's finally reacting. Oh, we're not doing that. In which we come up. I said up. We come up to the break and market structure right there, in which order flow has shifted, or we are changing from bearish to bullish. So this is the distribution. Let's go ahead and delete this, in which we already ran the buy side liquidity that we wanted to take. Jeez, man. Anyway, after we take out buy side, we come back, 2 down close candles. What's that? It's an entire order block. Let's mark that, bring that out. Price goes above it, activates it, refers into it. Let's look here. Let's see here. Barely reached equilibrium. That's a good thing. We refer to it 2 more times. 1, 2. It's respecting it very, very well. If you see this, you can enter. But if you don't see any reaction, exit. But you do see the reaction, so what? You stay in. Beautiful, right? 1, 2. Hold on, let me turn this thing on. 1, 2. Spikes up, then has that final one, and then it shoots up. Amazing, isn't it? Now, reminder, you can still hold this trade. You don't have to get out at 3. At which 3, it does. What's the word? At 3, it does begin to reverse because that final macro is coming up. So for this scenario, you probably got to use your a bit more advanced skills and say, okay, it's time to get out because it's 3 o'clock. We're getting close to the final hour macro, and that's typically when price will reverse. And does it reverse? Uh, yeah, I would say so. It does reverse a good amount, and it's still reversing right now, like at 7:47. So let's go to the London silver bullet now, wherever that's at. Let me turn on my kill zone so I can see it. Okay, here we go. Wow, this looks clean already. Jesus, man. Okay, let me turn off the kill zones now. So 3 to 4, let's mark that. 3, right here. 2, 4. I'm trying to move fast for you so I can make this video quick. I'm trying to move as fast as I can for you. Here we go. All right, starting at 3, look what happens. We have a bunch of time distortion, time distortion, time distortion, time distortion, time distortion. Now, at 3, what are we in? We are in a macro, 250 to 310. You understand it? You see what's going on here? We had an hour of time distortion. A lot of it, a lot of time distortion. So when this macro kicks in, it should do what? Start delivering. But it did not start delivering until what? 3 o'clock. Why? Because that's a silver bullet. Now watch what happens within this silver bullet now. Right off the bat, 3 o'clock, we jump up. What do we take out? This buy side liquidity up here, the top of the accumulation. I can mark it as buy side, Jesus Christ. And then all this liquidity down here. We take it all out. It's ran. Done. When we reach that, or we cause a liquidity purge, we fail to go above it. What does that mean? We might reverse lower. We begin to drop, 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 drop. You can see this order block right here get respected. Starts dropping them more aggressively. I don't even think you possibly could have gotten an entry here. Yeah, there was literally no entry you could have gotten. Not with the stuff you know so far. Yeah, nah, no way. Yeah, no way. You would have missed majority of it. That's with the stuff you know now. I really should not be teaching this. Actually, you could have used that order block I literally mentioned just a couple minutes ago, this right here. Reason being, we are failing to go above that liquidity purge, and we can clearly see that we have a accumulation manipulation type of scenario going on here. Bunch of time distortion, back and forth, back and forth, back and forth, back and forth, manipulation. Then we begin distributing, in which we start respecting this order block. Look here, look here. You're probably like, oh, why not this one? Why not this one? It's bigger, it's thicker, it's just a bigger candle. Well, reason not is because look at where the candle is. Look at where the candle closes. It closes above the liquidity purge. If you expect price to go lower, after the liquidity purge, you do not want to enter above the liquidity purge. You don't. You might be like, oh, don't you want to enter on a premium? I've experienced this multiple times, and I'm saying this from obviously experience. Whenever you sell above a how would I call that? A rally into a liquidity purge. If you sell above a rally up into a liquidity purge, it's likely that price will keep running past it if you sell above it. But if you wait for price to drop lower and actually show signs of it wanting to go lower and failing to go past that liquidity purge or that buy side liquidity, then it's a pretty good chance that it's going to respect that order block or whatever reference point that you use that's below the liquidity purge. It's just common sense, right? So using this right here and it coming up to it and respecting it and look at the reaction. You see what I'm talking about now? If you would have used that order block, you wouldn't have gotten that good of a reaction because we came up into it and it took 3 candles to move what 4 points. You get what I'm saying? That was a crazy. I'm gonna keep that in, but you understand what I'm saying now, right? It's right here. It's right here in hindsight. Well, in hindsight, of course, but you get what I'm saying. So touching the order block and entering there, you would have caught all of that, which is a very decent move, honestly. Now, the point of liquidity that you could have sought be this right here. That right there. Because mind you, look at that fat gap we got right there. Look at that. See that right there? Mm-hmm. Yeah, that needs to be filled. You're probably like, oh, no, it doesn't. Now, why do you say that? Because look at this order block. This order block has sell side delivery, and this has buy side delivery. That means this gap is balanced. Whoa. Very interesting, isn't it? So we have a lot of levels of liquidity, honestly. We had the bottom of the accumulation. We had these equal lows here. We had this low below those equal lows, and then we had those lows there. So there's really a lot you can target, and all of this is out of session. But I would recommend you just wait. Let's draw a dealing range. Hold on, from here to here. You can look and see where each level of liquidity is. Since we're in a premium, we want to take price down to a discount. So the highest probable would be this one. The most probable be that one right there. That's the one that is likely to hit first. Why? Because it's below the equilibrium, which is a discount. You're probably like, oh yeah, these lows here. Yeah, those will work too. And then those too. Those will work also. If we begin, not begin, but if we continue displacing lower. And do we do that? Yeah, in which we continue displacing lower past that low. So first, target that. Then if you continue seeing displacement, you can probably take a little partial and leave some runners on and target that low there, getting your full target. Pretty simple, right? Yeah, real simple. So the silver bullet is really, 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 really simple. It's not hard at all. It's just time-based, easy setups. Okay, I think did I mark it in there? I think literally the definition of a silver bullet is high probability time-based trades or time-based something that ICT said. It's like time-based bread and butter. Yeah, I literally have it here. The silver bullet is a time macro that offers high probability setups, mainly using fair value gaps within a short period. I meant to put order blocks in here too, but yeah, you get what I'm saying. Um, I'm taking a little too long on this, honestly. I really should be done with this video. 24 minutes. This is too long for a silver bullet episode. Anyway, I'll be in this episode here or video episode, whatever it is, and I'll see you in the next one. Good luck and good trading.